take this opportunity to introduce Mr. Anil Rigo. He's a founder and CEO of Right Horizons. Anil's professional experience started with Wipro Technology, where he played a key role in business planning and mergers and acquisitions during his 6-year stint. And being an entrepreneur at heart, he found Right Horizons at the age of 30 and 5 years ahead on his original goal of existing corporate life at 35. He strongly believes equity market would do very well in coming decades, and hence through RH wishes to leverage his experience to help others to achieve their goals and dreams. So thank you, Anil sir, for taking out time and coming and teaching us about something what you're interested. So over to you.
Yeah, thank you, and welcome to everyone. I guess today markets are of great interest to many. If I go back and see the trends in people opening up demat accounts, etc., that's a huge trend. In fact, people say that thanks to COVID times and work from home, this is one way of also getting actively involved and doing something. I think it's a good thing, and keeping that in mind, one will try and share with you my own experiences, and I hope that as one embarks on one's journey, either doing it oneself or using an advisor, one is able to sort of take advantage of markets. And a lot of the time, we think that it's a great place to make money quick. We have certain notions about how we can make money on markets, and I hope to take you through certain basic principles in terms of how we can sort of go about that. So let me start off actually with a bit of my own example and my own experience of how I started investing in markets. As the story goes, I started very early, almost like in my second PLC days. I borrowed money from my mother, and actually she used to give me money to safekeep in those times, and borrowed some money from her and ended up using it in markets. I actually walked into a equity broker firm office, and then signed up everything, did everything myself. Okay, so I later realized that one had the interest in it. Markets, one has seen accounts as well, and so if you go back and see during the periods that I was actively investing, there were actually a couple of large market falls. So one saw both of the positives as well as the negatives, and I ended up doing a lot of research and going and investing in stocks that I thought would become multi-baggers. A multi-bagger is a stock where it goes more than 100%, and that was my focus and specialty. So that is a process that I set for myself, and one ended up seeing that a number of multi-baggers one was able to sort of get out there. In the second part of my investing journey was to be a little bit contrarian, and so when markets were down, I used to go back and invest in markets, and when markets had done very well, I would take some money out. What I realized is many times that time I used to use some other wealth manager, and when they came to me, they would typically give the opposite, because when markets are going up, it's easier to actually sell equities, and when markets are down, it's easy to sell debt, but those may actually be the opposite of what you should be doing. And making money in markets were instrumental in myself starting out on my own, because I had set myself a goal of retiring from corporate life by 35 years, and one was able to do it by 31 years, thanks to the markets and how one was able to build up an asset base. I had said I want to build up a backup income, a backup asset base before I actually go and start something on my own. So that was a bit of the journey, and through ups and downs, I think the big picture was definitely markets ended up giving returns. Okay, so so coming back to looking at how the Sensex did. Okay, if we see the Sensex is up 380 times in 4 decades, right? Which means it's 38,000. An index always starts with 100. Okay, but my question to you is, how many of us have actually made money? Right? It almost looks like a no-brainer, right? If I just stuck around here in a market which went up 380 times, I would have made great money. And if you go back and see from the period that many of us maybe were actively involved, say somewhere around 2000, 2002, etc., and even intermediate periods, if you see the graph is really upward sloping and maybe a faster upward sloping graph. So I think the point I'm trying to make is that while the Sensex has gone up, the reason many of us don't make money is because markets tempt us to do the exact opposite of what we should be doing. Okay, and there are some principles that I will capture in my session today. And so today's session is a bit of a primer. So I would call it a bit of a basic session. Okay, so we will continue to get into more advanced things and get into possibly even how to go back and invest into stocks directly and stuff like that. But this session is sort of the first one, so I thought let me keep it a little bit around basics and principles that we can use. Okay, so and I think if we just follow those principles, we will be able to do it. Now, while the index has gone up 380 times, let me give you, in fact, this is the book that I wrote, Honey, I Lost All Our Money. Okay, lots of jokes around that, saying that, yeah, is that me, etc. Okay, luckily no, but one had to, I wrote it in story form so that people will be able to relate it better and try to bring about principles in a story form. And if I had to teach a few principles, I think somebody needed to lose all their money. Okay, but a lot of the principles that went behind it were all live cases and studies that I've either experienced on my own or the privilege of having worked with so many clients. Okay, and we've seen a lot of it over this period of time. So actually the reason for me even to write this book, okay, was one of my client, and he was basically almost like 50 years plus. Okay, and he was a CEO of a software company, so reasonable experience behind him, not necessarily looking at taking very you would say that having a good amount of experience behind him. And I've called him Raj because I don't think it's appropriate to share the name. Okay, and he actually ended up investing in futures and options with one of the leading brokers. And we used to manage his portfolio also. And at times he used to come back to me and say, Anil, why do you have cash in your equity account? Right? You'd rather deploy all of it and try to get the best return. My point of is sometimes that cash may become the best performing asset, because if markets are going down, then holding cash may be the best thing to have, because you can also go back and invest at a lower price. Now he ended up starting investing in futures options, and he saw some success. Then he put in a little more money. He saw more success. Okay, and he saw some very good returns. Because in futures and options, if you get it right, you can really do well. And that's when he dabbled, put in a little more, and a point came when it was 2008 when the market turn happened, and he was caught on the wrong foot. He was long on the market when it fell down, and futures and options actually futures and options are what we call a leverage, which means you invest more. Your returns and losses can be more than your capital. Okay, so so that is something that happened, and so he missed the turning point and he lost money. He lost all the return that he had made, and unfortunately for him, he lost almost like 3 crore beyond his capital itself. and he had come to me from from the portfolio he had with us. We support a little bit. He sold his, he closed his bank fixed deposits, etc., and ended up having to put down that money. So this is my point to us, and we many times start off investing looking at either one perspective or the other. Either we are looking at all the time returns, okay, and we completely miss out that the risk side of it, or we are thinking of risk and we don't invest at all. Okay, both of which are not right. So how do we participate in that market which say went up 380 times? At the same time, the question is, how do we not lose our money as well? And I think, it is definitely possible for us to make our money work for us, okay, and you actually make money, and it's by design and not by flow, okay, which basically means that you can make money just like you make money on, say, a fixed deposit. Of course, you cannot exactly compare it 1:1, but it can be regular and it can be by design, and it need not be by flow. But yes, it is very different from the bank deposit we are used to. Will it give me fixed returns? Will it be all the time? It's not going to be the case. But if you are able to, learn how to manage it, okay, then you can really make a lot of money for yourself. And I think a lot of the customers that I interacted with, etc., one finds that understanding of risk is a little not very good. So I think this is something that we need to keep in mind, because at times if we see that we have lost money, sometime during our investing period, the tendency is to maybe look at, okay, it happened because of ABC broker, it happened because of the market, it happened because of politics and whatever it is, okay, but many a times this is exactly what's happening, and we don't realize that maybe some of the decisions that we have made have actually led to a situation where we have lost our money and stuff like that. So I think it's good for us to step back always and see if I've lost money or something has not gone right, what is it that has gone wrong in the way that, say, I managed it? Is there something that I can do better? And obviously there may be external factors as well, but I think just a little bit of soul searching around that. And the other basic principle of finance is about risk and return, right? So you need to always be balancing risk and return. Now, I mean, what we see in industry is like this, right? When as advisors, when market goes up, most people want to see us deliver the best return. When market goes down, we'll get compared with a bank fixed deposit. Now that's obviously not a possible thing, and we need to keep in mind that this thing, that while we try to achieve the lowest possible risk, right, it's still a trade-off between risk and return. Okay, so we can only try to manage our risk better and possibly see returns sort of staying with us. But where you are investing in equity markets, clearly there is risk, there is a higher risk, and we need to be aware of it. But other ways to manage risk, how does risk move when I increase my time period? Those are all principles that we will talk as we go forward. And I mean, this is a basic one. I just want to touch on it before I go back. When you are looking at your whole investments, you need to first take care of your foundation, okay, and then start looking for upside. So this is something that sort of we need to do. And if there are any needs coming up, either in the current year or in close by, those are areas where you should not even try to optimize your return too much. See what is it that can get me best return on a liquid side. But liquidity is completely available and the safety is there to be able to use money for your needs. So manage your foundation well before you actually start seeking for sort of higher risk investments. Now, the other part is, I think, if you make money, you make money, on when you overcome these two emotions, okay, fear and greed. So that's the other principle that we need to keep in mind. That, and why does market make me feel like doing the opposite, right? How many of us went and invested in February? Okay, because at that point of time there was fear, right? And the news flow will be bad. It will always be the case. At the best points of time, you will find fear there, and at the worst points of time, you will actually find, say, markets are, all news is positive, and things look like, really cruising along, and that's where, greed takes over and say, okay, can I put that little extra money and make that extra return? So I try to capture a few graphs here more to make it illustrative, and feel free to post it on the chat. Okay, now this is and these are simple ones. I'm just giving it to drive home a point. If you see, this stock price is actually going up from 100 almost to 120 rupees out there. Okay, now let's look at what happened subsequently. Now, at this point, you may think, okay, should I buy? Should I sell? Okay, possibly many of us would have said, this is a fantastic stock because it's been doing well, right? Then what happens? Okay, you know what? This second, the down curve comes in. At this point of time, again, okay, would it be a buy or would it be a sell? Yeah, some of us can, put it on a chat. Do you think I would buy the stock at this point of time, or would I sell it?
Or you can unmute yourself and answer also. We would be happy to interact. We need more of interaction sessions so that we will also try to understand what I hope you guys are understanding or not.
Yeah.
If anybody can unmute and please talk about it.
So would you buy or would you sell at this point of time?
Anil, can you hear me?
Yes.
Okay. I think, Anil, for me, I will look at the fundamentals of the company, like, how the ratios are doing. And this can be a good opportunity to accumulate also. So I'm not ruling out that.
Yeah. So, yep.
Yeah, James has replied by depends on the other fundamentals.
Okay, wonderful. So I think we have a group of reasonably evolved people. Okay, so that's wonderful. Okay, actually, this is how the particular stock moved up. Okay, so
what's your problem, Satish?
Could you please mute?
I told.
Yeah, sorry.
Yeah. So I think when once you answered, if you can mute back, I think that'll be great. Yeah.
Yeah.
So this is how it actually ended up moving up substantially. Okay, so if you see, this initial part became a very small part of the whole thing, and this went up to 150 rupees. Okay. Similarly, this particular stock, you may have thought, oh, maybe it's a great time to buy. Okay. Now it went up a little. Yeah, you know what? I think it's a great thing. I bought it. Okay. And not knowing that the subsequent leg is significantly down. Okay. Similarly, this is how it did. I would think that many people would look at buying it. It actually ended up going down, but subsequently almost a significantly good W-shaped recovery. Okay, so the point I'm making is that this is exactly what will come to you, and the future can be a little random actually. Okay. Now, definitely we can go back and look at fundamentals and stuff like that. But I can tell you that at some of the best turning points, the fundamentals will possibly give you the opposite direction. Okay, and markets have a way to be predictive. Okay, and you'll find that the stock price moves first. Okay, and then possibly you'll know why it moved. If let's say it was at a peak and it fell down sharply, fundamentals all being robust and very good. Okay, then subsequently you'll realize that okay, these are 3-4 things that happen, and you'll actually find deterioration in the fundamentals as well. So that's something that sort of one needs to keep in mind while you're doing it. If we are able to set aside fear and greed, and I thought let me take you on a journey of this one person who always who tried to invest in markets. And this is a chart, and it will evolve as it goes ahead. Okay, he says, yeah, price is going up. Let's watch the market. Okay, the trend is holding. I'll buy on the next fall. It goes up sort of further, and the falls actually came, but you thought that, okay, maybe I'll buy, it can fall a little more and then I will buy and miss it out, or just got busy somewhere. Realize subsequently, oh hell, I missed the fall. Okay, but I'm not waiting any longer. Others, I'll miss the trend. Let me buy it. Okay, and then markets come back and say, oh, you know what? Good thing I didn't wait. Okay, I actually am started making money. Okay, and then comes the fall. Okay, so you'll see what happens then. Yeah, it's a correction. Let me increase my position. Right? Brilliant. At this price, let me double my purchase. Okay, and ouch. As soon as it goes back up, I'm now going to sell. Okay, so the complete change of mood, as you can see, right? It goes on further. I don't believe it. It's down to this level. It's hit an absolute bottom. Maybe there's temptation to go and buy it, but probably somewhere here, he ends up stopping. So, okay, now let's wait for it to recover. Otherwise, this will, take a very long time to, as an investment to come back. Okay, and then once another steep fall, oh hell, what are the regulators doing? Problems in the market, everything, and how can regulators allow such things to happen? How can government allow it? Okay, and at this point, totally frustrated. Okay, enough, I'm just going to sell out before I lose any more, and I'm staying out. Okay, markets again, yeah, good thing I sold, it's fallen further, but then, okay, it's going to tank. Again, anyways, I told you so. Then the move up starts. Oh, what? What the hell? More crazies who are going to actually go to the cleaners. Okay, and I've seen this before, right? I've actually done this and I've lost a lot of money. Okay, and yeah, this is a good. I knew all this is going to happen. Little sulking out there, and oh my God! I mean, before I miss out, let me buy again. Okay, so for many of us, sometimes this is the story, and while maybe this particular chart actually exaggerates it a little bit. Okay, but you will find out that I was trying to make a point that at the best times in the market, okay, you will feel like doing exactly the opposite. Okay, and the whole environment, etc., will be like that, and that is why many of us don't make money. And my point of saying that, how do we work to overcome fear and greed in markets? Okay, and so I'm coming back to some of the principles of that. Okay, one is on markets. Actually, most of us want to get rich quick. But if you look at it, actually, there's a great impact of compounding out there. So you will find that 70% of your wealth comes in only 26% of the time if you actually do the compounding formula. Okay, and that's true. Now you may say, yeah, you know what, this is a very theoretical formula, but let me show it on graphs, right? And we have somebody who's actually invested and done it for such a long period of time. And if you see here, I mean, actually, most of this spike, if you can see in this scale, happened here, and that's all thanks to sort of compounding. 53 years under Warren Buffett. This is what the huge money made, $19 to $290,000. Okay, so that's the type of thing that is there. So my point is, you make money in the long term, so you should be looking at long-term investing. My second point about we talk about, most of us think that we can make money quick. So I'm trying to tell you that, first of all, you need to look at it from the long term, and you'll make a ton of money, and you make it in multiples, if you do it right. Now, coming back to, this is a very busy chart, but I just come back to the bottom. Okay, I just captured the years so that you have a bit of a visual effect. And what we've done here, we've said we just captured the index. Okay, there are a few years which I've hidden out here at the beginning, but I think from 2005 onward we've captured each year. Okay, but to give you a bit of a perspective of how markets, if you look at a 1-year return, this is just the Sensex, okay, and this is where it ended up, okay. So now, if you go back and see 1 year, or 3 years, or 5 years, okay, you will find that if you invested on a 1-year basis, okay, if you 13 out of 41 years, you would have lost money on the Sensex. Okay, if I had a 3-year perspective, okay, which means that I bought in 79, sold in 82, so, and if I continued with that, okay, so you will ended up seeing that in 7 out of 39 times have lost money. The index has been lower in 7 periods of 7 3-year periods. But if I looked at a 5-year period, okay, only 3 out of 37 times, which means actually less than 10% of the time I've actually made a loss out there. And so what it means that the probability of loss, okay, only 8.11% of the time I've actually lost money. So the point again I'm making is, if you look at longer term as well, one is you can make larger money and it multiplies, but the second point is it also lowers your risk significantly, okay. And if you look at, that's where they say 5 years is a good period, because, and you can see that here, 8.11% of the time only the index has been negative, okay. And I looked at it in a slightly different way, right? Many of us say, okay, but my bank FD has done better than my mutual fund, right? It's not because of the market, it's maybe because of how we invested. Because if I look at here, beating that 7%, it's actually higher than inflation. It's possibly a debt return that I've kept, but I've kept a higher inflation because in past years the inflation in India was not just as low as it is right now. So it would be unfair to look at a lower number. So if you look at here, even if I look at most of the time, so if I look at 5 years, 27 times out of 37 times, which is 73% of the time almost, I have made a higher than 7% return. So just imagine that if I spread my money over multiple periods, right? And this is what I was saying, that you can actually, investing will make you money surely, and irrespective of market conditions, if I'm able to overcome fear and greed, okay, look at long term, spread my money out, don't put it all at one time, either through systematic or just phased investments. Okay, then the law of averages will catch up with you. And if you have invested in 10 different periods, there's no way you will actually end up losing any money. And of course, if you look at a longer term period, actually anything like a 15-year period, interestingly, you've never lost money if anybody invested with a 15-year period. Okay, so which means it becomes risk free, right? And if you look at, on the other hand, above 7%, it's almost like 96.3% of the times the index has made more than 96%, on a 15-year basis. Okay. The other point I'm making is about, actually looking at disciplined investing. How do we make it disciplined, make it as a habit? Okay. And because a lot of it is about our mental construct, fear and greed, like I said, and disciplined investing actually reduces my number of mental errors and biases that I have, and that sort of ensures that is a mechanism for you to actually deliver returns, not as fluke but by design. Okay, but what do you need to do for that? The point is, can you train your mind to think contrarian? Now, it's not easy for you to overnight be in a situation like February of this year and go and buy, right? So you need to start training your mind to say that, yes, when market is going up, I have to be cautious. When market is coming down, I should actually, it's lower risk, right? If an index has fallen 30%, okay, the further fall may even be 30%, but from the higher level, the fall was could have been 60%. The largest fall so far has been 65% in 2008. On the other hand, and that's the absolute worst, right? Most of the time, we also have a chart that's saying that how 30% is not unusual. Okay, but the thing is, I should have at least deployed some money at that point of time, even if I thought that markets would further go down. Okay, so that's the one way to say, how can I train my mind to think contrarian, especially with markets, and if you do that, you'll actually end up making money. The second part of it is, nothing comes free, and it requires effort from our side as well to study, and especially if I'm saying that I want to invest in stocks directly, right? There's that much more effort that you need. You need to do research, you need to understand, and you need to work on markets, work on principles, investing, study, be aware. I mean, some of it may not be our strength or area of competence, but some awareness and giving it some time, I think will definitely sort of do well. And the third is, and I think that's the best way to go about it is, can you make investing a process, and then you will see consistent returns. Okay, and like I said, even when I was doing it, when I look back and saying that maybe why was I able to also make reasonable return on markets, I had this thing about actually saying I want to search for multi-baggers. Okay, and of course at that point of time maybe I did not have too much of financial knowledge, but I would just keep looking at and studying various publications, newspapers, etc. And maybe my point was, out of 10, which of these stocks that have come out as recommendations do I think can go up to 2x or more. Okay, and that was a bit of my way of going about it. So the point is, can I make it an investing process? And of course, if like some of us did speak about looking at numbers, looking at ratios, definitely those all add and make it more consistent. The point I was making that time was, there are two parts to it. One is the emotion in markets and the forward-looking stuff, where it will not all the time be that way. But if I end up actually following an investing process, I look at the financials and invest. And if I'm able to bring in a little bit of contrarian thing into it, okay, some valuation measures maybe, etc., then I would actually do pretty well. Being contrarian is that is something that I followed all my life, and it has worked very well. Now there are other ways to make money. Some of them use trending, charting, technical analysis. So there are all different ways to make money. So I'm not necessarily saying this is the right thing. I'm sharing this is what I've done, and this is what reasonably well. And I think some of the largest global investors also have used a contrarian style. Warren Buffett is an example. Okay, and you will see that they have made reasonable money. And so like I said, train your mind to think contrarian. Look for opportunities in disaster and vice versa. Okay, the other part is, while you're looking contrarian, you have to be looking at a long term. And why is this? It is because let's say I bought gold, for example, about 3 years back, even in the portfolios. Okay, and for some period it did nothing, right? You don't know when exactly the turning point comes. So most of the time you will end up investing a little earlier. Similarly, we invested in pharma stocks, even in the portfolio. Today I manage the Right Horizon funds. So I took a bit of a contrarian call when I stepped into a fund management role. And the investment into pharma did very well. I don't know if you saw yesterday, most of the pharma companies, even after a large run, have seen another 5% to 16% upticks on a single day. Okay, so that is something, and these best returns sort of come in when you get it cheap, and when you get it, when everybody else is, selling that you are buying. Okay, and I remember we had Mr. Shankar Sharma come on one of our webinars, and he actually invested in Amazon at $11, and that it was $11 because it was really doing badly as a company. In fact, one of the leading investment banks gave a sell call on Amazon, and that was the time that he bought, and it did phenomenally well for him. And study market cycles and its linkages, because I think one thing that has worked very well for me is understanding linkages, between gold, because gold, for example, is also telling us other things. Gold, as soon as gold starts going up, it's telling me that market is getting cautious. Okay, There are other, of course, it's a very simplistic one because you can also find currency depreciation like what is happening now. The central banks are putting a lot of money into markets and splurging out there, and some of these will ensure that gold as a safety haven will only gain in terms of value. So it's important to study market cycles, and you can do that well for yourself. Like I said, markets are an opportunity, and you will find that this is the large correction since 2000. If we have this to March 20 as well, okay, Feb March, okay, and so the point is, while corrections have been reasonably short, okay, the largest was 20. So if I leave the extremes, okay, 2 and 20 months is an average anywhere between say 3 to 14 months or so is what the downturn has been. But after the correction, if you see after 1 year, the returns have been very strong. After 2 years, the returns have been very strong. So the point I'm making is, if you're able to follow a bit of a contrarian style, I think take advantage of market opportunities, it'll actually do. Other principles that you need to keep in mind: diversification is key. As retail investors, I've seen many times that there's excessive allocation to one particular sector, and that's normally the sector which is leading at that point of time. So if you go back and look at when real estate was doing very well as a sector, a lot of retail money went into it. Similarly, you will keep on finding that financials right now. So across the board, you need to keep in mind, if you're investing in stocks, then not just asset classes, but within it itself, have sufficient number of stocks, have across sectors, etc., and then it does well. But the point I'm making here is, you'll find different sectors do well at different points of time. Pharma was the bad boy of the last market uptick, and this time it's doing pretty well. So it's very likely. So similarly, like if I look at asset classes as well, you'll find that at periods when say equity delivered some of the worst returns, you'll find that gold did extremely well. Okay, so that's sort of a bit of a consistent message that has happened. Okay, so we need to diversify across. And some things for people about investing in stocks versus mutual funds. Investing in stocks, if you have the time, you have the inclination, and you are willing to spend that effort to go back and actually manage it. Otherwise, I think mutual funds have a wonderful systematic investment concept, which can make you make money even if you don't have the time and the inclination, and you possibly will make a lot more money than what some people do in sort of short-term trading. So just to sort of summarize, what I would suggest that we need to do if we want to make money and by design and make it large. Okay, not just in small thing. Let me give you an example of one person I remember who came on television, right? His grandfather invested in MRF, and he invested something like 20,000 shares in MRF in something like 1990. Okay, and completely unaware, he came on television and he said, what, my grandfather got paralyzed, and I need some money. So you have these shares of MRF. What do you think the value is? Okay, can I exit? And what are your advice? You know what the value of those MRF was? 125 crores. Okay, I mean, the person on the other side was just couldn't hold himself back, and you can go back on YouTube there. That's a video which is there. So the best money, and when it's very large, it comes when you look at long term. Okay, when and you really make money out there. So my takeaways for you today is about, first of all, as a basic, understand your risk profile. Take as much of risk that you are comfortable with. So sometimes, we may not be good at, managing volatility. In which case, can I manage my risk better? Can I not invest in stocks, etc. Second is about, diversifying and maintain an appropriate asset allocation. Okay, so that so this basically takes care of your foundation, like I told you. Then subsequently, start looking at, can I be a disciplined investor? How do I dedicate time? How do I study stocks? How do I study markets? If I don't have the time, okay, then possibly I stick to mutual funds, to portfolio management, use an advisor, etc., who can support you. Okay, but if you want to do it yourself, you do it when you are able to spend the time and also have the inclination. Overcome fear and greed. Okay, like I said, how do you train your mind to think opposite? Don't follow the herd. Okay, I strongly suggest a contrarian style, and you can choose a style that suits you. But my experience as contrarian has done very well. Maintain a long-term perspective. I already gave the example and spoke about it. You invest in stocks if you have, like I say, the inclination and you can dedicate time. And my point is, last is, it's very important to monitor your investments rigorously. So that's broadly what I have from my side. So I'm happy to take your questions. Okay, and
yeah, thank you, Nil sir, for such a nice informative. So I have on the chat few this thing. I'll just read it out, and then we will go to the people. You can unmute yourself and ask questions. I have Prashant KV saying, great chart. It conveys the importance of long-term investing. Please add comparison with other asset classes. And Kapil says a very informative session, and James says excellent charts. And Manaz has a question. Can you suggest some tips to think Contrino? What are the factors and measures to be considered?
sorry.
Can you suggest what are the factors?
Yeah, please.
Yeah. You want to repeat?
No, I think if the person is able to come back and ask it, it'll be good. And first of all, thank you for all your kind words. And Prashant, yes, I will actually look into it and see if we can even send it up as a follow-up to some of. Yeah, go ahead.
Yeah, yeah. Somebody
So
has.
I
Yeah,
have a
go ahead.
question. Shall I?
Yeah, sure.
Yeah. So when you say long term, don't you think it's a very dynamic marketplace? And given that it is 2020 and we cannot compare 2020 with 1987 and 1980s because the dynamic there was very different than the dynamic that we have right now. The company which was a blockbuster in the last decade may not be a blockbuster in the next decade. So how would you balance in that scenario?
Yeah, in markets always, nothing is as simplistic. You have something else? Sorry.
So basically, I to summarize my question, I just want to know what is long term. Is it 1 year is a long term, or 3 year, 10 year, 15 year? What is a long term?
Yeah, so I would look at decades as long term. Okay, and let me explain. Right, you had a valid point, and what I was trying to explain to you is that nothing is as simplistic. Right, while I put it this way, there are always ifs and buts and hows and stuff like that. Where so markets are very complex. Okay? So I'm completely with you, and I also manage and. Can we mute, please? Yeah. Can I? And I manage a PMS portfolio, and you cannot, not keep tracking your investments. Okay. So while I'm a fan of Warren Buffett, I believe that I don't know if you can hold something for life. Okay. And maybe if some of the exits happened, it would have been done much better for him. So I think that we need to look at a longer term perspective to investment. Let me put it that way, and look at because when you look at a longer term perspective to investment, you can make multi-bagger returns. Okay, even in this case, you'll find that in shorter term, maybe you will also make those. Okay, but I'm with you that you need to track your investments, and you may need to take course corrections, and that's why I said you have to monitor your investments as well and to take course corrections wherever they are required.
Okay.
Question
thank you.
Came up.
Yeah, Deepak has a question.
Yeah.
You had raised a hand. Deepak, you can go ahead with your question.
Yeah, sorry, I was the person who asked the last question. I just raised my hand. Yeah.
Sure.
So yeah, he answered my question.
Yeah.
Okay, I
Yeah,
think
that's it. Thank
Sandeep has raised a hands, so you can go with your question.
Yeah, hi, sir.
Hmm.
In terms of making sure that one buys low and sells high, can we use asset allocation and rebalancing as a methodology for our long-term investment?
Yeah. So in fact, that may answer even the previous question as well. And I suggest that quite a bit. Not only asset allocation, I think dynamic asset allocation, right? So if you're also able to bring in some, say, market valuation parameter and stuff, and in fact, in recent times, which we thought would be volatile, we've done, say, dynamic asset allocation funds as an example, much more. Okay, so even on our PMS, for example, we try to bring in a fund which, fund of funds which manages, between dynamically. So that is one definite way to actually, reduce risk for you. And it is seen that in the longer run, some of the dynamic asset allocation funds, depending on when you look at it, if you look at it a moderate period, sometimes it delivers better returns than even equity as a whole, right? Of course, if you look at it at times when markets are down, it will do much better. If you look at it at times when markets are in a secular rally, you will find that dynamic allocation funds will, underperform. But in the longer run, definitely, it is one strategy. Like what you said of, right? Can I always make money? And where I look at a longer term perspective, the system and the process takes care of it. Definitely, it's a very good question.
Okay, I think next, Kapil, you can go ahead. I can see that you have written that, ma'am, I have a question. So you can go ahead with your question, Kapil.
Yeah, ma'am. Thanks, ma'am, for providing me the opportunity to ask a question. Sir, actually, I'm very new to this investment. I'm learning the intricacies of market. So, what's the entry and exit criteria of investing in a market? And the second thing is like which instrument is better to invest? It's FD, mutual fund, or in stock market. Which one is better so that we can get a good return?
So when you're saying entry and exit, you're talking about for yourself, I mean, as a person, or are you saying what's the best time to enter the market?
As a personal investor.
Okay, as a person. See, actually, I think the earlier the better, right? And I started very early. As I said, right from my second PhD days. And why is it so? Also because of the compounding benefit, right? Over a period of time, as your returns compound, it goes up much more. Okay, but how I suggest people to do is, start off maybe gradually. While if you've never invested in markets, maybe do a systematic investment. Okay, and that can be the best way to start. In fact, can you do a systematic investment, say, if you are in the taxable slabs, etc., can you do a systematic investment in a tax saving fund? So you are also taking advantage of, the tax saving as well as that. Okay, I would believe that if you are starting lump sum, then you can use, say, dynamic asset allocation funds that were just mentioned earlier, and that can be a way to see it. As you go by, subsequently, once you've built your portfolio, then you start going to maybe PMS or stocks, and then look at it. And my suggestion is, when does somebody, today we have a lot of people, starting investing in stocks, right? What are some of the points I'm a little worried about that, okay, because many of them, I think, will end up losing money, right? But markets may first give them the hype. It may feel that they know it all before it gets them down very sharply. So ideally, even start off with a virtual portfolio. Okay, run it for some time. Then start off with a set amount, fix an amount for yourself. Say, depending on how well you are placed financially, it can be right from 10,000 to say 5 lakhs, etc. Work on that, and then as time goes by, expand it. Now, coming back to your second question of what is the best investment avenue, whether it's fixed deposit, mutual funds, etc. I think I always believe that there's no good or bad investment. Okay, it's good to follow an asset allocation that is suiting your risk profile. So if I'm a high risk person, then I can say have 75% into equity, very high risk person. So if I'm moderate, then I can have say a 50% equity. And so the first thing you should look at is how much do I set aside into risky and lower risk assets. Okay, which means what we call as debt and equity. And one way to do that is to say, 100 minus my age is a thumb rule. So if I am, say, 40 years old, okay, then 100 minus 40, which is 60%, can be in equity. So once equity and debt is there, then you have to go in down within equity what, okay, large cap, mid cap, etc. You can use dynamic asset allocation funds. Okay, within debt, what is it you can do? Bank FD, debt mutual funds. Again, a bank FD may be okay for somebody who's a very senior citizen, doesn't understand markets, and is not taxable, right? So it may be a good point to think, as long as you're able to lock in returns at good points of time, right? So that is thing. Now you may have post office schemes, etc., etc. But the large money, comes in. You make your money work for you when you are able to deliver a return which is on a post-tax basis able to beat inflation. Okay, so for example, if I have an 8% FD, okay, if I'm in my 30% bracket, okay, so which means 30% of the government, 70% is to me, right, which is 5.6%. And if inflation is higher than 5.6%, then I'm eroding my wealth, right? If on the other hand, inflation is less, I'm able to create wealth, and I'm able to make my money work for me. Now, in the long run, it's shown that equity-related avenues deliver a much higher return and make money work for you. However, like I said, you have to follow certain basic principles.
I have one question on the chat by Annie Chandran. Why is that even when results of companies are good, the share prices go down drastically? Is this market for operators and not for investors like me?
No, so it is, like I said, it can look very random at many points of time. I don't think it's about operators and thing. I believe today the market, the volumes are large enough that it's a little difficult to misuse the system too much. Okay, especially when you work in liquid stocks. Okay, where it is illiquid stocks, yeah, there are operators who can maybe play around, and they know they can play around there, so they actually go there. Okay, but the whole point is, in the long run, if you see, okay, you will find that the earnings growth and the stock market will sort of deliver somewhat similar returns. Okay, there will be periods when it delivers lesser, somebody will deliver more. But at short terms, okay, you will find that it varies. And what is the key reason for that? Because market is discounting the future. Okay, so many a times you may find that, okay, something is in expectation itself, results go up. And let me give an example of like Reliance, right? In its a recent time, and the law, and it's in news, so you can maybe relate to it better. There were a lot of deals that they ended up doing, right? And now it may not have yet reflected in performance. Of course, there are other performance parameters which made maybe the share price go up as well. But there was further run up that happened just on some of the news, right? And the results may actually come in later. So there may be a lag, and market has already moved and taken that consideration, right? So you may find that when the results actually come, maybe a year from now, and you may see that spike happen, the share price already may be, have discounted it, and you may just find that from there it falls, but if you follow a discipline and a longer term thing, you'll find that over a period of time, if you're also able to understand market sentiment and look at how market discounts the future, it'll become a little more clear. But definitely markets, because there are emotions in it, right? There's fear and greed in it. When many people are investing, there's a crowd thinking that comes in, right? And that may actually make things go a little all over the place. And I'll give that example to you again. In fact, on my LinkedIn, where I sort of started a learning series, I gave the example of onions, right? There was a period that a couple of years back, onion prices hit the roof. Okay, then yeah, everybody started growing onions, all the farmers. The price really came down. The period then, it was available. You would see boards around saying 5 kgs, 100 rupees. It went to 6 kgs, 100 rupees. And then again, there was a spike recently when, the weather conditions were not great. Okay, and the same story happened. So I'm saying wherever there's demand and supply, you will find that these things happen, a little bit, and you'll find that these movements happen. But the point is, markets discount the future, and so you need to keep that in mind, and may not exactly at all points of time be completely in line with what the results are declared.
Okay, Mehnaz, you can go with your question. I think you had raised a hand.
Yes, thank you for that, Meghna. Good afternoon.
Sorry, I hope I pronounced it properly.
That's all right. My name is Hansen, so that's fine.
Okay, Hansen.
Thank you for the presentation, Anil. I think you had some great slides in there. Just had a quick question in terms of being contrarian and thinking contrarian. I mean, I've used P ratio as a metric for being contrarian, but it doesn't always work. Like, for example, if there are companies which are quite innovative, they can have P ratios of greater than 100. So just wanted to check with you as to, how do you think contrarian, and are there some quick tips that we can use or quick metrics that we can use to being a contrarian? Thank you.
Yeah, so I think there are a number of the standard ones, right, around P, price by book and stuff like that, but they are all measures. Okay, if I try to do a model, I'll probably use a combination of them. But you have a very good point around when you come back to stocks, right, and you've seen that growth stocks, for example, have done exceptionally well, and market discounts the future, and where the future looks like growing very, very fast, you may find that the P multiples really go through the roof. Okay, so and let me take, let's say a Bajaj Finance as an example, right? So and maybe every time that you would have sold it, okay, you would have always regretted your decision of going back and selling it, even though Bajaj Finance may not be like an internet company, right? You may find some of the better listed examples. Unfortunately, in India, there are not too many out here which are non-linear ones which are listed, but you will find that like an Amazon or Facebook and Apple, right? So they actually find valuations really go through the roof, right? And they will continue to do very, very well. So that makes it a lot more complex. And like I said, there are always no simple answers. And you may find that some of these companies actually do very well for extended periods of time. So what do I do in cases like that? My mind immediately starts looking for, fundamentally, is there something that I think can start going wrong? Okay, and so you may not, this will not come by any easy measures. There's no way you can get any multiple to go back and screen. So then you have to go back to saying that, where do I think let's say a Bajaj Finance can slowly start plateauing, right? And I think we saw some of that recently, that some of the things are beginning to slow down. So that's where it may be time to start taking some money off the table, right? And there's no simple answer, but again, I thought technology stocks in the US were beginning to sort of lose growth, okay, till COVID came, right? And so my point again is that while the view may be there, again, you have to be cautious, you have to be open to the fact that may again reverse and change, right? So from here, again, one is watching it carefully to see that, okay, now there is some momentum left. Now let's at least watch through this time, but let me keep my radar on to say that, okay, what's a good time to start maybe looking at coming out. Okay, so that is something which one can do. And at times what I've done is sometimes I've just gone and traded the stock a little bit to take away some of my upside, where I think it will possibly say just, and some of it can be just random things like, okay, it's coming closer to 2,000 rupees. I think possibly 2,000 rupees will be a bit of a resistance level, so let me take some money. But that may be for a small marginal part of it to try and manage risk. Okay, so the way I look at it is just that. And but there's no easy answer. And yes, maybe this is a little bit of what I could share in terms of what I do.
Yeah, thank you, Anil. I think the Bajaj Finance example is good. I missed it at 23 rupees in 2009, and I can't regret enough. Thank you for that. Thank you for the answer.
Okay, Jaydeep, you can go with your question, please.
Yeah, hi Anil sir. Great slides. Just wanted to get your ideas because I think we have a lot of sources what to buy, when to buy. Yeah, and I'm myself is a great believer of long-term investment because that's where the bonuses, the dividend comes. But are there any tips where we can decide when to sell a stock? Because often with long-term investment comes a risk that we end up holding some of the stocks which over a period of time loses its sheen. So any last or quick tips when actually to identify that, okay, time to say goodbye to a particular stock?
So what do I do when I say, okay, first, like I said, I start looking for potential things that can either slow down, go wrong. Okay. And some of it, somewhere, I look at multiple indicators and those also come back and sort of help achieve that. Okay. So one will be a perspective of the market itself, right? And that's an important one. So the first thing is when I want to start selling aggressively, okay, I will start looking at, okay, how is the market valued at, okay, and do I think that there are points when the overall market itself will collapse? And we saw that when the market collapsed, every single thing went down, including the FANG stocks, including the ones which sort of benefited, and subsequently they'll come back and run up. But so that is one thing. The second is coming down to stock level. Again, it's not an easy one. One is to say, can I look at the historical valuations? Can I and if they are just a little bit disciplined, maybe that whenever it's coming, and it depends again on the sector, right? When it's a sort of a cyclical sector, and let's say it's a manufacturing company, industry, etc., it may be a little bit easier because at some point they will end up it will end up catching up and slowing down. It becomes a little more difficult when it is, let's say, like a Bajaj Finance, like I said, is financial services, and it can continue to run for some time. We saw HDFC Bank, right? And so what one needs to look at, you exit a stock completely when you see deterioration. Okay, I partially exit a stock when I look at the overall market as well, and where I see resistance levels. Okay, if I think that things are catching up, but where I feel at some points of time it's a sectoral view, right? I'm very watchful, for example, on financial services right now. Okay, and some of it has just a simple reason that the index weightage of financial are very, very high compared to the past. Okay, similarly, when you look at some of the industries, like I spoke of pharma, right, and at a complete low, then you do the opposite, saying that yeah, pharma will come back so some point of time, and this is a core sector. It's not something which is not required in day-to-day life, right? And because whenever at those points you may find so much of negative news, right? And it just look at it that way. But coming back to a point of selling, similarly there you will have a lot of positive news. So where you'll have to, it's not an easy one. Selling actually is the more difficult one. And if you are able to get selling right, I mean, then you'll do very, very well.
Yeah. Anil sir, I know we are out of time, but can I validate my understanding of this contrarian concept, what you spoke about? So is it that identifying something which is not in limelight at the moment? For example, I know today everybody is talking about specialty chemicals, everybody is talking about pharma, but there are some sectors which are very well beaten at this stage because of the COVID. So is contrarian view looking for something which probably not everybody is right now talking about, identify those and investment in those? Will that qualify as a contrarian view?
Yeah, so I'll give examples of these one or two things and maybe what went into the thinking. So interestingly, we also invested in specialty chemicals.
Yeah.
Okay, and we did some of those. Of course, we may not have got it right at the beginning, but we did it reasonably early, and we had a high weightage to them. Now, what we saw that the fundamental thing where actual data was showing China was manufacturing less and less. Okay, and it was a no-brainer that somewhere that will move to Indian companies who are reasonably well placed there. Okay, similarly in terms of on the pharma side. So yes, but it's not as simple as that, because pharma was down for what, possibly a decade, right? So the difficult one is, when in this period do you come in? Okay, so you, at least I look at coming in when I also look at emotions, when people are sufficiently frustrated.
Yeah.
Okay, like gold as an example. When I went back to my team and my clients also, didn't take me very seriously when I said gold is going to do well, because they were so frustrated in the last period of time that negative returns and very poor returns. Everything else was doing well, and this thing was a sore thumb. So that is it's not easy. But my point is that the only thing is
not what to identify, but what to ignore and what to avoid, because that
Yes.
makes things quite easier. Because when we start filtering out,
yeah. The other part I'm saying is that, like, you spoke of pharma, and pharma has done very well. They're not necessarily a short-term moves. Okay,
Yeah.
they could last 5 years. It could last 7 years. The last time pharma lasted 15 years, right? No simple answer, but I'm just saying that one is, keep in mind that they can continue to do well, because the worst thing on earth is, you found a sector, okay, took away 100% return, and that sector goes up 300%. You did everything right, but you are, went away too early. So, which is why I say, first you do partially, okay, but start looking for signs where the cycle is likely to change.
Thank you, Anil sir.
Yeah, sorry, Anil sir. There's a last question by Melvin, so we will answer that and then we'll close. So if you have time, otherwise I will tell Melvin to say we can.
No problem. You can take it.
Yeah, sure. Melvin has is, why does NAV of debt fund fall sometimes when there is no equity component in them?
Yeah. So debt funds actually have two parts. There's interest and there's capital appreciation. If you invest in a bank FD which is not traded, okay, there's only interest, okay, and so there's no capital appreciation and capital loss, okay. So in the case of debt funds, especially if you look at longer term debt funds, depending on the tenure, if I have a 5-year to maturity, okay, and interest rates say come down by 1%, right? Somebody on that bond will be willing to pay much more. Okay, and he will only be expecting, if it was 9%, it came down to 8%, he's expecting 8%. So we'll actually compensate you with a capital appreciation over those 4 or 5 years and give it to you upfront as a capital appreciation. Similarly, the opposite. If on the other hand, interest rates went up from 8 to 9%, you will find that you actually lose money. Okay, of course, there are other reasons why debt funds lose money. There's a credit risk as well. So if any underlying investment has gone bad, and sometimes it, based on certain requirements by SEBI, etc., they need to write down, okay, which means they have to account for it, and they have to, write off certain investments when they go to default grade. Now, some of the companies may actually get money from that, from that particular investment, but in terms of, their NAV, they need to account it for it accordingly. Yeah. Meghna, I remember at the beginning there was one question which was on chat, which I was suggesting that the person can come on. Can you take that?
Yeah,
out?
he said he came.
Okay.
Hansen was that
Okay.
person. So thank you all for attending, and hope you have got some knowledge about it. So we do like this sessions, free webinars every Saturday. You can follow us on LinkedIn, Twitter, as well as Instagram. So any questions, any